thank you very much for everyone for joining us this afternoon. My name is Björn Conway. I'm the Chief Executive of TPXimpact. I joined in October last year. My background is sort of long-term professional services, business transformation and technology change, and more recently sort of building integrated digital transformation businesses. To my left is my colleague, Group CFO, Steve Winters.
Good afternoon. I joined TPXimpact just over a year ago, helping them with their finance transformation program, and became CFO at the end of September last year. My prior life was at WPP, where I spent over 20 years. For a long time, I was Group Chief Accountant there, and latterly, for the last 3 or 4 years, was Deputy Group CFO.
So one of the key things that Steve and I both bring is experience of running large organisations, which is particularly relevant for TPX because we're now behaving as a large 1,100 strong organisation rather than as a group of smaller businesses. We've got a short presentation to take you through, and I'll take you through some of the highlights, quickly through a summary, FY23 Summary, a little bit of context and background about our market and our business. Steve will then pick up on our financial and ESG results, and then I'll come back with a bit of a vision as to how we plan to take the business forward, how current trading is looking, and our outlook for this year. And then obviously we're very happy to take questions afterwards. I guess the key element that we want to get across today is that we recognise FY23 was a very challenging year for the business, but we are now in a position where we have a new vision for the business. We have a 3-year plan, strategy and 3-year plan for how we're going to develop the business and take it forward. And we've also got a record backlog in terms of work coming into this year. So we've got a really good foundation for our business going into this year, and we're maintaining our guidance. So just to touch on here the summary for last year. So Steve will pick up on some of the financial figures, so I'll move through those quite quickly. But we ended the year towards the higher end of the guidance that we issued at the beginning of this calendar year. New business wins in particular have strengthened, and they've strengthened over the last few quarters. And we'll talk a little bit later on in the presentation about the strength of our new business wins in the first part of this year as well, particularly in April. One of the things about TPX, one of the strengths of the business is that actually the teams are very purpose-driven and very keen to deliver impact alongside their clients. So one of our tasks as a management team is to balance that with our commercial returns. And this slide also shows some of those people, places and planet measures there. So we've seen a really good headcount growth this year, which obviously contributes to our margin improvement initiatives, but also is a sign that we are an attractive place and we're able to recruit people in the current environment. Our staff retention rate is 84%. That's a significant improvement on even just a few short months ago. And hopefully that's reflective of our attempt to be transparent and engage staff. Our staff themselves, of their own volition, donate hours. So 2,500 hours were donated in the last financial year. And we've also maintained our commitment to offset our historical carbon usage for the acquired businesses. And we invested in a business called CO2.com, which uses that money for planet-based initiatives. The final piece on this slide is just at the bottom right there, you can see how our services split. We're 72% public sector, and that is central government, local government and health, and 28% in the commercial sector. We've been investing in our sales capability over the last few months, and in particular, we're investing at the moment in our commercial sector. Just to give you a bit of context in our market, so you'll see that we actually operate in a vast market, and it's got huge potential. In terms of the UK, we predominantly operate in the consulting and solutions part of that market. And I think probably one of the things that's worth getting across is that if I was talking to you 12 months ago, I'd be talking about the number of clients we have that are £1 million plus in revenue, and they were of the order of about 16 clients in that catchment. Today, I can talk to you about multi-year contracts, and our largest contract, as you'd have seen from recent announcements, is 4 years and 49 million. So we have sort of stepped up a level in terms of the strategic nature of the work that we can win and our ability to draw together our services from across the business. And that's a reflection of us operating under a single brand. In terms of the 3 market segments that we've put up here, just a couple of key points from each. In central government, There's obviously a huge demand for digital transformation services. It's all about citizen engagement, and it's all about improving the effectiveness and the efficiency of providing data and information to citizens and helping them access the services they need. One thing that's working in our favour is that public sector procurement is becoming more disciplined. Digital market-based frameworks are being used, and that provides access for us to compete with some of the larger players. In the commercial sector, we've got real depth, but with a limited client base. So we see the opportunity there both to develop business within those clients and also to develop across subsectors, which are predominantly financial services and utilities. And in the not-for-profit sector, our customers are really looking for far better engagement with their donors. So we can assist that, we can support that, because in the current environment, the cost of living challenges that are around, attracting new donors is quite difficult, but actually encouraging existing donors to donate more is somewhat easier. In terms of who we are, I'll just give you a little bit of context around the business. Our vision for the business and our purpose, if you like, is to deliver people-powered transformation. And what that really means is that people are at the centre of what we do, both in terms of experiencing the output of what we develop with clients, so that customer journey that they go through and the engagement with the organisations we support, but also tapping into the sense of purpose, the want to deliver impact and the enthusiasm that we have within our own staff base. In terms of our capability, I talked a little bit earlier about us being able to win larger contracts, and that's because we are able to deliver a true end-to-end capability. We can get involved right at the beginning in terms of design, and a lot of that design is user-centred design, so user-centred research, or it could be community engagement type work to really get to the grassroots of how we improve services, right the way through to making data more accessible. So some of the recent acquisitions, particularly, for example, Swirl, really emphasises on making public sector data accessible to a wider audience. Our experience division really talks to how do you make that engagement real? How do you build the contact management systems, the websites, the interfaces with those customers to make that experience a real experience and an impactful experience? And then we've got the technology capability, both in our own staff and then also in our associate network, to be able to deliver and actually build things. So we're actually right the way from initial ideas through to actually building product for our clients. We have a hub structure here at TPXimpact, so that allows us to recruit from a wide base in the UK. So people can have a regional hub that they are attached to. It also allows us to serve our clients from regional hubs. But we also operate a hybrid system, so we're highly connected as an organisation. And we've been investing in that network. We're currently sitting in our new London hub, which is a new office, and we will combine our two existing hubs into this one. So we're actually able to bring our teams together to promote co-working. And we've also improved our facilities in Manchester and Chesterfield. So I've got three examples of our client work, just to emphasise three different points. So the first example is for the Department for Education. The key element here is it's a client that we've supported for a long time. This piece of work is a relatively small piece of work, but it actually set the path for a much larger engagement we won at the beginning of this year in April, which is a £27.5 million engagement for 2 years, centred around teachers, centred around improving the data availability. And as you can see, this track record, we're working with teachers, supporting that environment, and that really laid the path for that. The second track record that we've got really demonstrates how our work can be part of the critical national infrastructure. So during the COVID pandemic, actually, we had the 111 service in Wales, had technical issues. The current provider could not sustain the service. We very quickly stood up a service which is actually still in operational use today. So really plugged into critical service delivery. And then the final example is an example of how we use our skills and technology to make data accessible and useful as information on a broader stage. Particularly in the public sector, clients have a lot of data, and really the challenge is how do you make that data usable? How do you get value from it? Which is one of our key ideas. So there are only just three examples. We've got a very broad range of examples, but hopefully those bring the business to life a little bit for you. So I'll hand over to Steve now, who'll talk us through our financial and ESG results. Steve.
Thank you. Good afternoon. So our revenue for the year was £83.7 million, which is at 5% on a reported basis, but as you can see, down 7.2% like for like, stripping out the acquisitions of Peak and Swell in particular right at the start of April 22. I'll show you how that pans out, that growth by quarter, in a moment. Profit on an EBITDA basis, adjusted EBITDA, was £2.5 million and 3% on a margin. Both of those figures were at the higher end of our expectations when we last provided an indication of full year outcome at the end of January. Adjusted PBT of £0.7 million, and on the right-hand side you can see a reported operating loss of £19 million, largely due to impairments and acquired intangible amortisation, and I'll show you a reconciliation of the adjusted to the reported numbers in a moment. Sales backlog is the amount of committed revenue in respect of the next financial year, i.e. FY24, March 24, £80 million going into that year of committed revenue, which is very encouraging and built off the significant new wins and the momentum in new wins in the latter part of last year. Net debt at year end was 17.5 million, and we had just under £7 million of cash at the bank. And just on the new banking arrangements, we have a 30 million facility with HSBC. At the end of the year, we draw down 24.5 of that, and that less the cash gives you the net debt number. We received a waiver of our debt covenants at the end of March and also at the end of June last week. And we've agreed, after constructive, helpful discussions with our bankers, on fresh covenants that will apply for the next 12 months based on minimum liquidity levels at each month end and an EBITDA figure by quarter that will is set as a proportion of our budgeted expectations. The previous covenants in relation to 2.5 times net debt of 2.5 times EBITDA and interest cover of 4 times will come back and apply from the quarter ending 30th of September 24. So my takeaway from this is that, despite the obvious operational problems we had in the last financial year and the implications of that on our debt position and borrowing position, we now have a solid framework from which we can operate and run the business over the coming 12 months, supported by our bankers. On the revenue, there's a 5-year history on the left-hand side. We are targeting FY24 like-for-like top-line growth of 15 to 20%, which would effectively give you the 96 to 100 range. You can see in the 24 column there, effectively the blue band at the top. We're also targeting an EBITDA margin improvement to between 5 and 6%. Coming back to the quarters of the year just gone, you can see the dip there in the middle 2 quarters of the year, -11% and -15%, largely because of a lower order rate coming into the financial year and delays in the middle of the year in relation to projects coming on stream. That led to the downturn on revenue in those 2 quarters. And as you can see, it came back in quarter 4 to not quite, but almost flat in the quarter. And the first 2 months of the current year on the far right-hand side is positive like-for-like growth of 5%, which is in line with our budgets and in line with our expectations. The issue very much of last year, which, as Björn said at the outset, was a challenging year, was in part due to the revenue issues in the middle of the year that I've described, but also on the cost side, getting the balance right between permanent staff and contractors was challenging, and the cost base increased primarily because we gave an enhanced benefits package to our permanent employees right at the start of the financial year in relation to holiday entitlement, pension benefits, etc. We still stand by that commitment to our staff. They are our business, and rewarding them in an appropriate, well-rounded way is important to how we ensure the increase in retention rates that Björn pointed out at the start to 84% currently. A year ago, it was not quite the same picture. Just to give you a sense of how the revenue for FY23 breaks out by business, consulting is our most significant part of the business at almost 40%, digital experience at 15%, Red Cortex and Kits around 20%, that's our platform managed services business. International, we have a small operation in Norway and a more significant one in Bulgaria, equating to 17% of our revenues. And data and insight, which is the combination of Peak and Swirl, the two companies we acquired in April 22, account for around 9% of revenues. Coming back to that reconciliation of adjusted or headline numbers against our reported operating loss, again, you can see here the first two green bars all relate to goodwill and acquired intangible assets, whether the amortization thereof or the impairment charge that we've taken following the review of the future growth and profitability prospects of certain of the acquisitions that we completed more than 2 years ago. We incurred 2.5 million of restructuring costs, not dissimilar to the prior, in part due to the integration exercise that was taken out at the start of the year and right-sizing the business for the future performance expectations. Adjusted EBITDA of 2.5 is where we ended up, which is, to repeat, the margin of 3% in the year. Turning to ESG, this is a really important focus for the group. It marks us out as a differentiating factor because of our focus within it and what it means to both our clients and our employees. People, places, planet, all together providing a sustainable and trusted company in TPXimpact does good for both our people and our clients. And it goes hand in hand with the financial objectives we just laid out. Some numbers on ESG. I won't read all these out. We have about 800 people on a permanent basis within the group at the moment. Our total workforce is 1,100, including associates or contractors. During the year, excluding acquisitions, we effectively created almost 140 new jobs within the business to service our clients. Our representation goals are contained in our annual report. Our FY23 results are largely in line with our targets for this year, but clearly there's still work to do, and it's an area of focus for us on diversity and inclusion. In terms of the planet and our carbon usage, it's just over 2 tonnes per full-time employee, some improvement of last year. We donated 2,500 hours, that's our permanent employees donated this time, to a number of volunteering activities, whether social orientated. The 13 million is an attempt to give an indication of the notional value attributable to social value in terms of our government contract wins. Typically around 10 to 12% of the total contract value qualification criteria are driven by the social value component of the bid. If you multiply that 10 or 12%, and we looked at all the new business wins over the last 12 months, you come out with a notional figure of £13 million, so somewhat significant. And again, 72% of our revenues come from public services, not just public sector, but also not-for-profit, charitable organisations and the third sector. Some highlights from our ESG work this year in terms of employees. We introduced new company values, hand in hand with our new vision for the business and 3-year plan. In short, pact, purpose, accountability, craft and togetherness to bring together the workforce, and these values were driven very much through a consultation programme with our staff. On the carbon side, as Björn mentioned, we donated £100,000 to CO2.com, which is a portfolio of planet initiatives sponsored by Time magazine in the States. We launched a purpose platform to help us track those 2,500 hours. It's called LAA, and we introduced that during the year, and it helps us get people to focus their attention on those volunteering hours and their dedication to the community. An example of which, and we're very proud of this, our Future Leaders Programme, which has been around for a number of years now, where we bring people from disadvantaged or underrepresented backgrounds to develop their entrepreneurial skills and talents through a programme of mentoring, coaching of people within TPXimpact to develop those ideas and offer help and support. And it's a very successful, impressive programme.
Thank you very much, Steve. So now I'd like to talk a little bit about the business going forward and our sort of vision for the future. As Steve's already set out through those measures, we really benefit from looking at the business as both purpose-driven and a commercial enterprise. So we've talked about people-powered transformation, both in terms of our clients and their need to interact better with systems and customers. Our vision is to be an integrated, focused, and high-performing, purpose-driven digital transformation business. Now, what does that mean? That means that our clients benefit from a coherent and broad range of services that we can bring together to meet their needs. We've already talked about winning larger engagements with clients, which are more strategic in nature because of the breadth of capability we can now bring together. The way we do that is moving forward, we're moving into more of a professional services type model. So something that's based on services and sectors and allows us to be very adaptive and responsive to sector needs and also to the development of new services. We're doing this in a way that we're going to be simplifying the business, making it coherent, and also improving the operational maturity. And that over time feeds into our margin improvement that we'll see at the back end of this year and into next year as well. It also provides a really solid foundation so that if we move back into acquiring, for example, niche capabilities into the group, we can do that in a way that the capabilities immediately fit in and get traction with the rest of the group. The way that we're approaching this is we're taking a very disciplined approach, and we've got a 3-year plan that we set out. This first year is all about what we've called balancing commercial and purpose, because they're two very, very strong elements of the group. And to a certain extent, we need to help the organisation make those decisions, achieve that balance, and achieve the commercial outcomes whilst delivering against our purpose. Steve and I, particularly in the months since we've joined, we've sort of implemented some additional management disciplines around performance management and around forecasting, which are improving our visibility of the business. And we're going to continue doing that, improving governance process and systems throughout the business. We've talked at the bottom point on this year about further integration when stability allows. And what that means is that, particularly in the case of our consulting business, which will be the foundation for our digital transformation business, we want to make sure that business is operating predictably and the systems that are in place are capable of operating at that scale, but also accommodating other parts of our business that will join it. So, for example, the data and insights business will eventually come together with the consulting business as part of the digital transformation business. Moving forward as we go through, it's really important that we keep purpose at the heart of everything we do. It's really important that we improve management information so we can provide predictable outcomes. And we've got a separate digital experience business because it operates more as an agency rather than a professional services business. And in that business, we're supporting that to become the UK's leading purpose-driven agency. As we move forward into our 3rd year, we think by following this strategy, we'll end up with this simpler, more coherent business that will allow us to seamlessly provide end-to-end services to our customers, but also allow us to do that operationally in a very effective manner. That will start to feed through into 2 things, really. One is that we think we'll be able to grow consistently on a 10 to 15% basis in terms of revenue each year, but also we'll be able to continually improve margins. And we're aiming to get to an EBITDA margin of 10 to 12% at the end of that 3-year period. So we've taken quite a disciplined approach. It's quite clear. And this is something we communicate with our staff, our team members, as well as yourselves. So just to give you a little bit of information about current trading and our outlook. And this is really a summary for the presentation as well. So we've had a very strong start to this year. You'll have seen us announce major wins with the Department for Education at 27.5 million over 2 years. And as I explained earlier, that's based on a foundation of great client work with the department in the past. We're also the digital transformation partner for His Majesty's Land Registry. And that's a £49 million engagement, and that runs over 4 years. So that provides us with real long-term visibility of our work. So it's a great foundation for us to have going forward. Trading for the first 2 months of this year is in line with expectations. So we are seeing revenue growth of 5%. We're expecting that, which is that's budgeted, and we're expecting that to continue and develop through the year. We're very focused on managing our working capital and our net debt position. We're not making acquisitions at the moment, and we're settling the last of our earn-out liabilities. So we settled those in June of this year. And probably really important for us is that we continue to enjoy a really good relationship with HSBC, our bankers. Steve and the finance team and the business units involved really engaged with HSBC, and we've got a very good foundation for continued support over the next 15 months and then returning to conventional covenant measures. I'm particularly pleased at where we've got to in terms of staff retention rates. 84% is good for our industry and reflects the need to bring new people into the business, but also the fact that we're appealing to our current team members in terms of the potential and career opportunities we can offer. In terms of looking ahead, as I said at the beginning, we all recognise that FY23 was a challenging year. There was a lot of change in the group. And we've now set out a clear strategy, a clear vision, and a 3-year plan to build on our already strong foundations with clients in terms of our ability to deploy our skills and to win these larger engagements. In terms of our margin improvement over time, it's going to be driven by scale as we scale up during this year. So we'll see margin improvement in the back end of the year, but also by the operational improvements that we're making. Our market is secure in terms of digital transformation is very much in demand, both in the public sector, the private sector and the not-for-profit sector. So we're confident that over a 2 to 3 year period, we'll be able to build the organisation that we want, achieve that predictable performance and achieve the revenue and EBITDA indicators that we've put into the presentation. So all in all, we're very pleased with what we've managed to achieve over the past few months. You'll see in the written prelim statement that we've pulled out some of the more of the changes that we've made in the business. Steve and I are very confident in the team that we have, the passion in our people and the market that we're operating in. So we're very pleased to be able to share that with you today and give you an indication of where we plan to go in the future. So thank you very much for your time and for listening. And I'm very happy to hand back to questions and answers.
So congratulations on the recent contract wins. As the pipeline conversion continues to grow, will you have to bring in more staff to facilitate?
Yes, we will indeed. We are already recruiting quite heavily and we've actually improved our recruitment capability. So a lot of our recruitment is done through digital channels. And we've brought in, for example, people who've got who are from LinkedIn, actually, because that's a very good channel for us. And we're enjoying good conversion. In terms of revenue growth through this year, we are recruiting, and we're recruiting for 2 reasons, really. One is to obviously be able to deliver those services in their own right. So as revenue goes up, we need to increase our capacity for delivery. But we're also very focused on recruiting permanent staff where we have long-term needs for skills and capability, and balancing that mix of permanent staff, associates and contractors, because that is one of the levers we've got to manage margin going forward. Steve, is there anything else you want to say?
Yeah, I mean, to put that figure on that, our expectation is that our headcount growth, combined firms and associates or contractors, will increase in line with revenue growth. So around 15 to 20%. Depending on how it pans out over the course of the year, ramping up as the year goes on in these projects, which are already kicking off. They both started with the first statements of work in May, so they are gradually starting. We'll need to bring in new people as the year progresses to support those as they grow.
What's your sense on how government contracts will develop moving forward?
So we're seeing a lot of demand for digital transformation work, and we're also seeing government using the digital marketplace more as a procurement tool. And that actually works to our advantage because it means that we're in a position where we can compete with some of the larger sort of more legacy providers and continue to compete for these larger contracts. So there's sort of an evolution in the way that things are being procured. The need to sort of improve service delivery and improve citizen engagement and improve access to critical services is ever there. And government is really sort of focused on digital transformation as being a key enabler for that. So we see long-term a really consistent demand and continuing demand for our services. And we see an opportunity to, because of our improved scale and because of our ability to provide that broad suite of services, we're better able to access that.
And quite a few questions on margins. The first question is, you've seen a huge squeeze on EBITDA this year. What's driven that? Is it overhead, smaller margins on contracts? And are there any plans to cut costs internally?
Steve?
So the margin change in FY23, I sort of touched on earlier. There's a number of factors where we had a cost base a combination of contracts and perms that in Q2 and to some extent Q3, when revenue was being delayed due to client-side delays, and the effect of our new business run rate at the commencement of the year was relatively low. We had a relatively fixed cost base in terms of permanent staff who also benefited from the range of benefit improvements that I mentioned earlier. That put pressure on gross margins. As the year progressed, the new business started to come through. In Q3, we won 41 million of new orders, and in Q4, 36 million, 115 million for the year as a whole. So there's a balance here in terms of being able to retain staff and use them effectively and hold on to them when these new business wins come through and benefit the business. Clearly, we are dependent upon the client for when, in fact, these projects get kicked off. And what we saw in the summer of last year, largely due to factors outside our control, were client delays on that side. So in terms of where we go from here, you'll have seen, Q4 was a little bit better in terms of that profit profile and indeed the revenue profile, better than even we were expecting 3 or 4 months ago. As we go into this year, our focus is very much on conversion of the new revenue that we've won, not least the 90 million of new orders in Q1, and as importantly, if not more so, the 80 million of committed revenue that's coming into the year, and ensuring that we are able to staff up properly in relation to that revenue and convert at an appropriate margin. At the same time, we have a firm hand on discretionary cost, but staff costs and the ability and their utilisation and how to service those contracts is the critical piece in terms of managing that margin in the months and indeed years to come. So our focus is very much on that, on improving our systems, which will require some investment on our side in order to improve predictability and visibility of that cost base, how it's being utilised effectively, improving our utilisation rate, and those factors will in turn drive margin improvement together with the absolute fact that we have great momentum now on our new business win rate.
So there's a question asking why it's going to take quite so long to get to 15% margin, and that was historically what the business was structured to do. So why is that not happening?
So in terms of the 3-year target, we put out a number of 10 to 12% for FY26 in terms of a margin target. But I think we have to recognise that there is still work to be done in terms of improving and managing the business. The business is different now from what it was even just 12 months ago. And the shift from a collection of owner-managed, acquired businesses that form the basis of what was the Panoply, now TPXimpact, has changed. It's a more coherent, cohesive group built around the divisions that we've explained in the deck. And that has obviously been an exercise that has, over the last 12 months, to some extent, disrupted the business. So in terms of going forward, in terms of particularly the larger contracts that have come through, it doesn't happen overnight. That revenue, it takes time to come through. We work with certain partners in certain instances too, which means that, that revenue, the 49 million, for example, it's not an even distribution over 4 years. It gradually increases, which is why in turn our margin progress will be gradual but progressive. And we set out 10 to 12%, recognising the fact that, as I said, the business requires investment in order to aid that predictability and help us manage the business in an effective way.
Are you able to talk through the anticipated margin profile of the different business units?
We'll disclose that by segment. In the annual report, we haven't put it into the release. It does vary according to each business segment. So as we haven't put in the release or the deck is probably better, as we have to treat everybody equally, to leave that until the annual report. Obviously, it does vary according to the type of business we're talking about and where they are in that progression curve that I described.
And to what extent are you trying to sell multiple services from different business units to the same client?
So we're trying to Yeah, so it's a very good question. So the way we're currently configured is we have what we call managing partners that lead on a sector basis. And we currently have a managing partner for central government, one for local government, one for health, and we're in the final stages of recruitment for one for commercial. And the idea of that is to better brigade the service offerings that we have across the business to bring those to bear for individual clients. So a really good example is that we have a very significant financial services client that we provide really excellent services. They love the services we provide in terms of business information, particularly helping them improve their gender diversity within their workforce on a global basis. So we've got a very, very strong track record. We've got a very deep relationship there, but it's actually quite narrow in terms of the services we can offer. So part of the role of our sort of building emerging commercial team is to actually bring our broader range of services into that client. I mean, they're keen to engage with us on it. We're keen to engage with them. We just need to mature that capability. So our kind of future, part of our future thing was one of the slides was around strategic account management, which is really looking at our clients, looking where there is the potential for us to offer value through our services, and then making those connections, and making the connections across the business and making the connections into those clients.
And what are your plans to use AI over the next 12 to 18 months?
So we have a team that I've appointed an individual to lead on AI across the business. And we actually had an update on this on an internal call earlier on today. And what we're looking at AI in two perspectives. One is in terms of clients' needs, and we've had lots of inquiries from clients who are either enthusiastic to look at AI or are slightly nervous about what the implications might be for their business and the implications of using it. And we're also looking at use cases within our own business. So, for example, improving our team members' access to our policies and our people support. So large language models, AI, will definitely be a key part of the future. Our data and insights division in particular, we already have deep capability there. We are also looking at it very, very strongly in our digital experience division. But we're taking a progressive view to it, because whilst there are big opportunities, there are also risks in some of the implementation of the model. So we're looking at it in the round, both from a client perspective and an internal perspective.
And can you explain why you see purpose as a key differentiator?
Yes, and I think absolutely, because it's one of the key things for us in terms of attracting and retaining staff. It actually provides, energized and passionate staff generally produce better outcomes for our clients. As you saw on one of the slides that Steve showed, we've attempted to sort of quantify the impact of looking at social value. So social value in particularly in public sector procurements is a key measure that is used to differentiate between who wins and who doesn't win. It's part of the scoring mechanism. So it really has got a very strong commercial benefit to it. And what it means is that when a public body procures, they want to see that through undertaking that procurement, the social infrastructure is improved. And that could be through training, apprenticeships. It could be through other initiatives that kind of leave social capital as well as just the delivery of an engagement. So for us, in the larger public sector procurements, it can be 10 to 12% of the marking scheme is dependent on your contribution to social value. So if you've got an organisation that is innately purpose-driven, obviously balanced with commercial outcomes, then you're starting in an exceptionally good place to be able to deliver that and to be able to compete against other organisations in those sort of commercial framework competitions.
And are we able to learn anything from the way that the businesses were run before their acquisition, when some were as profitable as sort of 50% and others eclipsing a 30% margin, and what we might do now to accelerate decent profitability?
Yeah, so one of the things that we've looked at in terms of coming up with our future strategy is how do we maintain sort of like the positive things about our various capabilities. So it's one of the reasons, for example, why our digital experience business, which has a slightly different operating model to some of our other businesses, is we will sort of nurture and develop that business as in its own right. In terms of some of the margin profiles, as Steve has mentioned, those businesses are now operating in a different context. I mean, we are a listed business, which is why obviously we're engaging with you now and sharing what we're doing. And as such, there are certain things we have to do as a listed business, which some of the original portfolio businesses wouldn't have had to do in their own right. Our sort of future and our future development of margin is based around keeping those niche capabilities and serving clients in those niche capabilities where we can, but also bringing the wider breadth of TPX together. Because if we do that, we can have longer term customer relationships, which reduces cost of new business winning and development, allows us to engage earlier, probably come up with more favourable commercial arrangements with clients because it's a win-win situation around value creation, and have longer enduring relationships, and that should improve margin longer term.
And there's also the question of scale. The scale that you get from being a business brought together that we are now, and the kind of opportunities that gives rise to, like the more significant wins we've talked about with the Land Register and Department for Education. There would have been very little opportunity to win that size of opportunity, as a relatively small owner-managed business. So the group itself has gone through some transformation in order to present itself to potential clients as a coherent, significant business partner that can help them in the longer term and generate not just revenues, but healthy margins in due course.
M&A's always been part of TPX's growth strategy in the past. How do you see it continuing in the future? You said not so much in the short term, but sort of short, medium, long term. What can we expect?
Yes, so thank you very much for that question. Yes, in the short term, we've got what we have in TPX is actually a very broad range of capabilities, and we're able to brigade those together to serve clients, and our job is to really improve the operational efficiency with which we do that. Sort of in the medium to longer term, there will definitely be needs for capability infill, so there'll be needs to improve capability or to bring new service offerings into the business. They'll probably be fairly small initially, and we'll obviously have a discussion around whether we grow that capability or whether we go out and acquire that capability. So I can see in the sort of medium term that we could be looking for capability infills. And part of our strategy is to build a sort of flexible and adaptive organisation that is able to go and do acquisitions in the future. So one of the things about integrating businesses, and part of our sort of thesis around TPXimpact, is we want to build a solid platform for the business, which will make future acquisitions easier to undertake and easier to incorporate. So we definitely have an eye on that, but our short-term priorities are to get the business that we currently have operating in a predictable, sustainable way. We already do brilliant things with our clients. We already deliver on our purpose outcomes as well. We just need to make ourselves more operationally efficient and effective.
What are the dynamics of your pricing of work? And is there any opportunity to drive pricing to your advantage to support a more sustainable margin?
So we've got, as you might imagine, we have several initiatives running across the business at the moment, both addressing revenue acquisition, pricing, margins in terms of costs and other things as well. We have parts of the business who operate in frameworks or environments where we are able to have regular pricing discussions with clients. And we also have parts of our business where we have engaged on a framework which doesn't allow price movement for 12 months or 24 months. So effectively, we look at every opportunity to have a positive conversation with our clients about the value we're adding and the price we can charge for our services. As we move forward, some of our services are obviously, we actually deliver sort of hosting services, or we have sort of platforms that we utilize for clients. So that gives you a slightly different pricing opportunities. But it is something that we're very focused on, and it's one of the levers that we are pulling, if you like, to improve margin.
Great, thank you very much. And that's the end of questions. Do you have any closing remarks?
Well, as I said during the presentation, really appreciate the opportunity to be able to share with you the work that the team here in its entirety have done, and particularly Steve and myself having joined in October. We came into a business that is very exciting, very passionate people delivering digital transformation services into sectors that really need them. Our task is to help the organisation sort of mature and grow and become more effective and more efficient. We're very encouraged by what we've seen. We do have a lot of work still to do, which is one of the reasons why we've set out a sort of multi-year plan. But our objective is to get to a point where we have an adaptable, flexible organisation that has more options. So it has options to grow organically or to grow inorganically. Certainly coming into this year with the order backlog we've got and the work that we've won in the early parts of the year, it gives us a really strong, solid foundation. Our staff engagement is good. As you can see, our retention rates have improved, and we think we've got a good foundation to continue to improve develop the business. So we're really enthusiastic, we're really keen, and we hope you found today's presentation useful, and we look forward to your continuing support. So thank you.